open any trading app you own. Tap the indicators list. The first one you will meet is called RSI, and it will already be set to 14. You did not choose that number. Nobody at that company chose it either. That setting was printed in a book in 1978 by a mechanical engineer who published it himself out of Greensboro, North Carolina. Every chart you have ever looked at inherited it from him. His name was J. Wells Wilder. He is not famous. In that one book, he introduced 6 tools at once, and 4 of them are still standard equipment 50 years later. In the next half hour, you get the thing almost nobody tells you: what the relative strength index actually measures, why 70 and 30 will lie to you in a trending market, and which of his tools professionals reach for instead. And you will get the part that got lost. Wilder never sold a single indicator on its own. He sold complete systems, every one of them with a rule for getting out. The world kept the numbers and threw the exits away. Start with the man, because his training explains every design decision he ever made. He was born on the 11th of June, 1935, in Norris, Tennessee. Norris was not an ordinary town. It had been built from nothing a couple of years before he was born to house the workers of a federal dam project, a planned settlement laid out by engineers for engineers. That is the world he opened his eyes into. He served in the United States Navy during the Korean War. Then he did the thing that decides this whole story. He went to North Carolina State University in Raleigh and took a degree in mechanical engineering. He finished in 1962. Hold on to that word, mechanical. Not economics, not finance, not statistics. He was trained to design physical things that have to survive contact with the real world and to test them until they either hold or break. A mechanical engineer is taught a specific habit of mind, and it is not the habit a market usually rewards. You are taught that a claim without a measurement is not a claim. You are taught that the tolerance matters more than the average. And you are taught the most unglamorous thing in the whole discipline: define your failure mode before you build. Know how the thing breaks, and know it before anybody depends on it. Remember that, because it is the missing half of this episode. He practiced as an engineer for a few years. Then he did what a great many capable people did in the 1960s. He went into real estate development in Greensboro, North Carolina, where the money was more immediate. And while he was developing property, he started trading commodities on the side to supplement his income. That is the whole origin. Not a hedge fund, not a trading floor, a man with an engineering degree and an evening. In 1972, his partners bought him out of the real estate business. He was 37 years old with capital, no employer, and a problem he could not put down. Because when he had turned to the market properly, he had run headfirst into something an engineer finds genuinely intolerable. And I want you to feel exactly how bad it was. Picture what technical analysis was in 1972. There is no chart on a screen. There is no screen. A chart is a sheet of graph paper. Somebody, often you, reads the closing prices out of a newspaper in the evening and marks a dot with a pencil. Tomorrow you mark another dot. That is the data pipeline. And the tools people used on those sheets were, almost without exception, shapes. This pattern is a head and shoulders. That one is a pennant. This is a triangle, and triangles break upward usually. Now ask the engineer's question about any one of those statements. How would I test it? What counts as a triangle? Who decides when it started? At what point is it wrong? There were no answers because the shapes were not defined. 2 people could look at the same sheet of paper and disagree about whether the pattern was even there. And both of them could be sincere, and neither could be checked. It gets worse. The advice attached to those shapes was almost always about when to get in. Buy the breakout. Buy the bounce, enter on the retest. Overwhelmingly, entries. And an entry, on its own, is not a system. It is a hope with a timestamp. Anybody can be right about a direction. The money is decided by what you do in the hours after you were wrong. So here is the situation Wilder is standing in. A field full of confident instructions, none of which can be measured, and almost none of which tell you when to leave. His response is completely characteristic. He did not write an essay arguing with anybody. He spent something on the order of a decade doing arithmetic. Understand what that meant without a computer. Long runs of daily price data worked through by hand and by mechanical calculator on paper for tool after tool to see whether a rule survived contact with years of prices instead of one flattering chart. And notice what he was really doing in all those years. He was not searching for a way to predict tomorrow. He was searching for something far more modest and far more useful, a number that meant the same thing every time you calculated it. That is the entire engineering shift. Stop asking the market what it is going to do. Start building an instrument that gives you an unambiguous reading so that at least two people looking at the same data are looking at the same number. And by 1978, he had 6 of them. The book is called New Concepts in Technical Trading Systems. It came out in 1978. It was not published by a New York house. He published it himself through his own company, Trend Research in Greensboro, a self-published technical manual from a former real estate developer in North Carolina. It is not a long book, and it is not a beautiful one. It reads like what it is, an engineer's specification document. Here is the quantity, here is how you compute it, here are the worked numbers, here is the rule. Inside it, he introduced 6 things at once: the Commodity Selection Index, the Directional Movement System that everyone now calls ADX, the Parabolic Stop and Reverse, the Relative Strength Index, the Swing Index, and his volatility work, which is where the average true range lives. 2 of those 6 are now almost forgotten, and it is worth 30 seconds on why, because it tells you something about which ideas survive. The Swing Index tried to answer a question that sounds simple and is not, what was the real price move today, given that the open, the high, the low, and the close all disagree with each other. It is an attempt to compress 4 numbers into one honest one. And the Commodity Selection Index was arguably the most ambitious thing in the book. It was not about when to trade, it was about what to trade, ranking a list of markets by which ones were currently moving enough to be worth your capital and your risk at all. Think about how modern that is. Before you ask which direction, ask whether this instrument is even worth your attention this month. That is a portfolio question, and it is a better question than most of what got famous instead. They faded for an unromantic reason. They do not draw a line on a chart that crosses another line. There is nothing to put in a menu, nothing to color red and green, and nothing to teach in 30 seconds. Survival in this field has a great deal to do with whether an idea fits on a screen. Now think about that as a batting average. 1 self-published book, 6 new instruments, and 4 of them are still sitting in the default menu of every charting platform on Earth half a century later. And here is the detail that ought to stop you. There has never been a revised edition. The book is still sold and still bought in essentially the form it was printed in 1978, with no update. Think about what that means. Every market this book describes has been replaced. Open outcry is gone. Decimalization happened. Electronic matching happened. Algorithms now do most of the trading in microseconds. And the arithmetic in that book is untouched, because it was never arithmetic about a market structure. It was arithmetic about price movement itself, which has not changed, because it is just the record of people disagreeing about value. So let us take his most famous instrument apart. Not the folklore version, the actual mechanism. And I promise you it is simpler than the mystique around it. The Relative Strength Index. First, clear away a confusion that costs people money, because the name is genuinely misleading. Relative strength, in ordinary market language, usually means comparing one thing against another. This share against the index. Gold against the dollar. That is not what this is. Wilder's index compares a thing only against itself over time. There is no second asset anywhere in the calculation. A better name would have been internal strength, and a great deal of confusion would have been avoided. Here is what it actually does. Take a look back window. His worked examples use 14 periods. Over that window, separate the days the price closed up from the days it closed down. Average the size of the up moves. Average the size of the down moves. Divide the first by the second. That ratio is the relative strength. Call it RS. Then squeeze it onto a not to 100 scale with 1 line of arithmetic. RSI equals 100, minus 100 divided by 1 plus RS. That is the whole indicator. Let me make it concrete. And I want to be clear that these are illustrative numbers, not a real instrument. Say over 14 days. Your average up move is $2 and your average down move is $1. RS is 2 divided by 1, which is 2. 1 plus 2 is 3. 100 divided by 3 is 33.3. 100 minus that is 66.7. Your RSI is roughly 67. Now flip it. Average up move $1, average down move $2. RS is not 0.5. 1 plus that is 1.5. 100 divided by 1.5 is 66.7. RSI is 33. So the reading is not a prediction and it is not a signal. It is a ratio of recent up force to recent down force, expressed as a percentage. That is all it has ever been. There is one more piece of the machinery worth knowing, because it explains something that confuses people the first time they try to reproduce an RSI by hand and get a different answer from their software. Only the very first calculation uses a plain average of the last 14 days. After that, Wilder does not recalculate from scratch. He carries the previous average forward. The rule is, take the previous average gain, multiply it by 13, add today's gain, divide by 14. Same for the losses. That is now known everywhere as Wilder's smoothing, and it is used inside the ADX and the ATR as well. Why do it that way? 2 reasons, and they are both engineering reasons. First, it means the indicator never lurches, because one big day dropped out of the back of the window. A plain rolling average jumps when old data leaves, which is a false signal manufactured by the instrument itself. Second, and remember he is doing this on paper. It means each new reading costs you 1 multiplication and 1 addition, instead of re-adding 14 numbers every single evening. He was designing for a human being with a pencil, and the design outlived the pencil. The side effect is that an RSI has a long memory. Every value depends on every value before it, fading but never vanishing, which is also why 2 platforms that started their calculation on different dates can show you slightly different numbers for the same day. And one word about divergence, because it is the other thing everyone is taught. The price makes a higher high, the RSI makes a lower high. You are told this means the move is weakening. What is actually true is narrower and worth stating precisely. The second push was less one-sided than the first. That is a real observation, and it is the honest content of the whole idea. What it is not is a timing instrument. A move can get less one-sided and keep going for months, which tells you immediately what it can and cannot know. It cannot know what a company earns. It cannot know that a central bank meets on Thursday. It has one input, the closes, and it does exactly one job with them. And now the part people get wrong, every day, in enormous numbers, the 70 and 30 lines. Almost everyone is taught that above 70 means overbought, so sell, and below 30 means oversold, so buy. Look at the arithmetic again and ask what 70 actually says. 70 says that recent up moves have been substantially larger than recent down moves. It says the buying has been strong. That is what a strong uptrend looks like from the inside. So, in a genuine trend, the RSI can sit above 70 for weeks. And every one of those days it is telling you the truth. And every one of those days somebody sells into strength because a number crossed a line, and the trend carries on without them. The failure is not in the instrument. The instrument reported correctly. The failure is in treating a measurement as an instruction. Here is the way to hold it that actually helps. RSI answers one question: how one-sided has the recent move been? A high reading means one-sided upward. That is information. It is not a verdict. And it is genuinely useful in the market where it is honest. A range-bound, sideways market with no trend for it to misread. In a trend, on its own, it will hurt you. Wilder's own book does not hand you the number and walk away. It puts every tool inside a system with an exit. Which brings us to the tool from that book that professionals actually reach for most, and it is not the famous one. It is the average true range. It has no fan club, it generates no signals, and it will never tell you to buy anything. Here is why it matters more than the rest. Before Wilder, if you wanted to describe how much an instrument moves in a day, you took the day's high minus the day's low. Simple and quietly wrong. Because it misses gaps. If a market closes at 100 and opens the next morning at 90, then trades in a tight band all day, the high minus low says almost nothing happened. $10 of movement has vanished from your measurement. Wilder's fix is exactly what an engineer does when an instrument underreads. He redefined the quantity. True range is the largest of three things: today's high minus, today's low, today's high minus yesterday's close, and yesterday's close minus today's low. Take that, average it over your window, and you have the average true range. A number in the actual units of the instrument that says, on a normal recent day, this thing moves about this much. Now watch what that one number lets you do, because this is the practical heart of the whole episode. It converts every question about risk into arithmetic instead of feeling. Where do I put my stop? Not at a round number and not at whatever feels far enough, at a multiple of what this instrument routinely moves, so that ordinary daily noise cannot take you out of a position that has not actually failed. How big should this position be? If you have decided in advance what you are prepared to lose, and ATR tells you how far the price normally travels, then the size is a division, not an opinion. Is this the same market it was last month? Compare today's ATR to the ATR of 6 weeks ago. If it has doubled, everything you calibrated is now wrong, including your stop and your size. Let me put actual numbers on that because it is the single most useful piece of arithmetic in this episode. And again, these are illustrative figures rather than a real instrument. Say a share trades around $200 and its average true range is $4. On a normal day, this thing travels about $4. That is the instrument's own natural breathing. Now suppose you put your stop $1 below your entry because $1 feels like a small, disciplined loss. You have placed your stop a quarter of one ordinary day's movement away from the price. You will be taken out. Not because you were wrong about anything, because you asked the market to hold still and it was never holding still. You have manufactured a loss out of normal noise. Instead, put the stop at a multiple of ATR. 2 ATRs is $8. Now, ordinary movement cannot reach it. Only something genuinely unusual can. The stop has stopped measuring your nerves and started measuring the market. And that immediately gives you the size, which is the decision most people never make on purpose at all. Suppose you have decided in advance that no single position may cost you more than $400. Your risk per share is $8. 400 divided by 8 is 50. You buy 50 shares. Not a round number, not what you happen to feel like, a quotient. And notice what just happened to the volatile instrument versus the quiet one. If another share has an ATR of $12, your stop is 24 away, and the same $400 of risk buys you 16 shares instead of 50. The ATR sized you down automatically in the dangerous thing and up in the calm one, without you forming a single opinion about either. That is what it means to have an instrument instead of a feeling. That is the engineer speaking, and it is the answer to the question the shape readers never asked. Not where is it going, how much does it move, and what does that make me able to survive? The same book contains 2 more. The directional movement system, which everybody knows by the ADX line it produces, does one thing. It tries to answer whether there is a trend at all, separately from which way it points. Here is roughly how it is built, and the shape of it tells you what he was after. Each day he asks a small question. Did today's range push further above yesterday's high or further below yesterday's low? Whichever is bigger is that day's directional movement, up or down. Smooth the up ones, smooth the down ones. Divide each by the average true range so that a big move in a volatile instrument does not automatically outrank a big move in a quiet one, and you get 2 lines, the positive and negative directional indicators. Then take the gap between those 2 lines relative to their total, smooth that as well, and you get the ADX, which means the ADX is not tracking price at all. It is tracking how far apart the 2 directional lines are, how decisively one side is winning. That is why the ADX line can rise while the price falls. It is not saying up, it is saying decisive. Direction is the other 2 lines' job, and this one has been separated out on purpose. The convention that grew up around it is that a reading somewhere in the mid-20s or above suggests a real trend is present. That threshold is a convention, not a law of the market, but the separation of, is there a trend? From which way is the genuinely durable idea? That is a more useful question than it sounds, because it is the question that decides whether your other tools are lying to you. If ADX says there is a strong trend, then the RSI's overbought reading is exactly the thing you should not act on. The tools were designed to be read together. And the parabolic stop and reverse, the dotted line that trails a price and tightens as the move continues. Look at the name. Not parabolic entry, stop, and reverse. Its entire job is the exit. The mechanism is worth a sentence because it encodes an attitude. The line starts some distance behind the price, and every time the move makes a new extreme, an acceleration factor steps up, and the line closes in a little faster. So, the longer a move runs in your favor, the less room it is given. The instrument is saying something quite unsentimental. A trend that has already delivered a great deal owes you nothing, and the cost of giving it back is now higher than the cost of leaving early. And when the price finally touches that line, the system does not go flat and wait for your opinion. It reverses. There is no moment in which you are asked what you think. That is a machine built by somebody who knew exactly which component fails first, and it is you. 3 of his 6 best-known tools are fundamentally about getting out, or about how much room to give a position. Exactly one of them is the one that got famous. That is not a coincidence, and it is the thing this episode is really about. So how did a book full of exit rules turn into a menu of buy signals? Nobody stole anything. It happened in the most ordinary way possible. The software arrived. Charting packages had to offer indicators, and an indicator is easy to code. It is a formula that turns a price series into a line. A system is not easy to code because a system is a set of dependent rules with conditions and an exit, and it has to know what you already own and how much you are prepared to lose. So the packages shipped the formulas. The formulas came with default settings, and the defaults came out of the worked examples in a 1978 book, and that is genuinely why your app says 14. Then the second thing happened, and it is about how people teach. A line that crosses a threshold is teachable in 30 seconds. Above 70, sell. Below 30, buy. You can put it on a slide. A complete system with position sizing and a volatility scale of stop takes an hour. And at the end of it, the honest answer is, this will be wrong a great deal of the time. And the exit is what makes it survivable. One of those fits in a lesson, a video, a product. The other is true. Guess which one propagated? And so the tools spread across the entire world in the incomplete half. Millions of people now use instruments built by a man who spent 10 years testing them in the one configuration he never proposed, alone with no exit as a signal. I want to be careful and fair here. I am not going to tell you. Wilder said this or warned about that because I am not going to put a sentence in a dead man's mouth that I cannot show you. What I can show you is the structure of what he actually built. 6 tools, half of them concerned with exits and volatility, every one of them presented inside a system rather than as a signal. The design tells you what the designer thought, which leaves you with a practical problem, and Wilder's own method is the answer to it. There are now hundreds of indicators in that menu on your phone. How would you ever tell which ones are worth anything? He did not settle that by argument. He settled it by testing, and the way he tested is something you can copy without a decade or a mechanical calculator, because you have a spreadsheet and he did not. First, write the rule down until it is unambiguous. Not buy when RSI is low. Buy at the close on the day RSI closes below 30, sell at the close on the day it closes back above 50. If 2 people reading your rule can disagree about what to do, you do not have a rule, you have a mood. Second, and this is the one people skip, write the exit before you write the entry. Where do you get out if it works? Where do you get out if it does not? How long do you hold if it does neither? Which is what usually happens. Third, define failure in advance. What result would make you abandon this idea? If there is no such result, you are not testing anything. You are collecting evidence for a decision you already made. Fourth, count enough of them. 5 traits tell you nothing whatsoever. The difference between a rule that works and a rule that is noise does not show up until you have a few hundred, and this is exactly where most private testing quietly stops, right at the point where it would have become informative. Fifth, keep some data back and do not look at it. Build the rule on one stretch of history, then run it on a stretch you have never examined. Anything can be made to fit the past you designed it against. Only the untouched part is a test. And there is a trap at the end that catches everybody, including professionals. If you try 40 variations of a rule on the same data, one of them will look wonderful, and it will look wonderful for the same reason that somebody wins a raffle. The engineer's protection against that is embarrassingly simple. Decide what you are testing before you look. The moment the data starts choosing your parameters for you, the test has become a search for the flattering answer. Do that honestly a few times, and something useful happens. Most indicators stop looking magic and start looking like what they are. Measurements. Some of them are good measurements. None of them are instructions. He did not stop in 1978. In 1987, he published The Atom Theory of Markets, and in 1991, The Delta Phenomenon. And it is worth saying plainly that the later work is a different kind of thing from the first book, and much more contested. His firm, Trend Research, and its subsidiary, the Delta Society, went on developing systems until 2008. In October 1999, he moved to Christchurch, New Zealand, and became a dual citizen. He was diagnosed with vascular dementia and Alzheimer's disease in 2020, and he died on the 18th of April, 2021, at the age of 85. The obituaries were modest. Almost nobody who used his work that day knew his name, which is, in a strange way, the highest thing you can say about a toolmaker. The tool outlived the memory of the hand. So what do you take away from this and actually use? 4 things, and they are all in the arithmetic we just did. 1. RSI does not compare your asset to anything else. It compares the size of recent up moves to recent down moves on that asset alone. Read the number as how one-sided has this been, never as an instruction. 2. Above 70 is not a sell. In a real trend, it is a description of the trend and it can stay there for weeks. If you only change one habit after this episode, change that one. 3. Before you judge any overbought or oversold reading, check whether there is a trend at all. That is precisely the job ADX was built to do. The tools were designed to be read together, and they contradict each other on purpose. 4. Use average true range for the 2 decisions that actually determine whether you survive, how far away your stop goes, and how large the position is. Both become division problems instead of feelings. And the 5th thing, which is not a rule but a habit. Wilder's real contribution was not any single indicator. It was the demand that a claim about a market must be computable the same way twice, by 2 different people, and that it must come with a definition of failure. Next Wednesday on The Toolmakers, a man who was not a trader at all, who proved with mathematics that the safest portfolio is not the one made of the safest things, and won a Nobel Prize for it. Harry Markowitz, and the idea that diversification can be measured. If this is the sort of thing you want more of, follow the channel. That is the whole ask. See you next Wednesday.